Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we are back with Chris Vermeulen of the Technical Traders. Chris, thank you for coming back on the show.
Hey, Steve, always a pleasure.
Yes, sir. Pleasure is all on this side of the table. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Macro view. Well, some people are saying I'm a perma bear. I am pretty bearish on the environment. Based on kind of the macro view, I feel like things are coming to a grinding halt. I think things were already coming to a grinding halt many months ago. Things were slowing down from a strong economy to a unstable economy. And I think the tariffs kind of kick-started kind of a downward slope or a bearish trajectory kind of for the global economy, which leads towards, I think, a big bear market in US equities, more so a financial reset across many financial or asset classes, right from stocks to commodities to even real estate. So my macro outlook is pretty bearish looking, and we're getting a nice bounce and rally in the market with some positive news or delay of bad news or positive news from Trump and China. But the market, I think, is climbing this wall of worry. I think it's a bear market bounce, and the economy and everything is, I think, going to go in the gutter later by the end of this year.
Okay, so you basically see it as slowing down. It went from a strong, I mean, it was a really, really bullish time a couple of years ago, and it's basically come to a grinding halt, unstable. Your bearish U.S. equities, and this little rally that we've seen, you essentially see it as a dead cat bounce or a bear market bounce.
Yeah, yeah.
Okay, okay, all right. Let's go to your strong suit here. Let's go to the charts, and can we start with the S&P 500?
Sure. Yeah, there's lots going on the charts. This is the S&P 500. On the left-hand side is the 30-minute regular hours trading chart, which allows us to take advantage of short-term moves in the market. Typically, when the market turns into a green bars into a short-term uptrend, typically we're looking for waves of panic selling. And when we have panic selling, it usually creates short-term opportunities. And more or less, if we look at the daily chart on the right-hand side, the trend is up and it's been screaming higher. I mean, it's been a very strong rally percentage-wise, but in the grand scheme of things, I believe this is somewhat of a bear market or dead cat bounce. It's very strong, and it's really getting a lot of juice from the tariff news this week. But I do feel as though it will eventually stall out and roll over and head down. So um, right now, the market is doing what I was hoping it was going to do in terms of breaking this high from back in March. And I was talking about this several weeks ago, saying if we can get up and the market is going to want to try to break this high, it's going to create a lot of people to cover their shorts. A lot of people were betting on the markets continuing to go down. And now that we've got this good news and this massive gap up a couple of days ago, and the market breaking this high, it's got everybody going from a bearish mentality to a bullish mentality. And that's what the market does best. It gets people excited, it gets them bullish, it sucks them into the market just before it kind of runs out of steam and rolls over again. So this is what I'm looking for. And it's really interesting because there's a lot of cool charts around what's been going on, Steve, in terms of this area of the chart, this area of the chart, and we're now waiting for the next one. So for example, if we were to just focus right here, and this is the same for the Dow, the same for the NASDAQ, it's pretty much the same across the board. They all have the same chart pattern.
Yeah.
This area right here, I was telling subscribers and telling followers, hey, don't be trying to pick a bottom. And everybody was talking about picking a bottom here, saying this is buy the dip, just buy the dip. And there's this really interesting chart showing how much money has piled into the leveraged long ETFs in February and early March. And so people were just piling money in, picking the bottom, buying the dip, and loading up with leverage. And what's really interesting is this is February and this is March. And I was saying, watch out. If everybody's trying to pick a bottom, it means the bottom is not in. And then the
Yeah.
market had that second leg down, and we had that real big downdraft. And this day right here, this big red bar was a Friday. And I remember telling subscribers, I'm like, listen, this was a day, the week and the day closing on the lows. It is going to carry over a ton of fear over the weekend. People are going to get more nervous just thinking about it. We're probably going to see the market gap lower. And then we're going to see everybody dump their shares in the morning on Monday. And then we'll probably see the market reverse and go the opposite way. And what's funny is when you look at what people were doing, the average investor, I this is the S&P 500, and we had that big down day here. It was like a 3.5% drop. And I overlaid the Google search term, inverse exchange traded fund. And the day that everyone decided to bail out and they're like, oh my gosh, we're going into a bear market, it was like news all across the board. Everybody searched inverse ETFs to profit from falling prices. So
Huh.
over here, they're all betting on the market going higher. And they took a beating and then they flipped directions and they all bet on the market falling. And then it goes up. And now the market is way up here already.
Yeah.
So this is like the most important thing to understand is, following price action is number one, but like sentiment of traders is such a great tool to know, what is likely to unfold. And so looking at where we are right now, Steve, is now we're coming up into this area. Now I'm waiting for everyone to get really, really bullish again. And it's starting. I've got people saying we're in a new bull market. All these people who are buying the dip are looking and feeling like superheroes. And maybe they are. The market may break to new highs and run higher. But at this point, based on the long-term charts, when we look at the weekly chart of the S&P 500, we have a series of bullish environments. We have a series of bearish environments. And right now we've come down into a bearish environment. So to me, because our technicals are telling us from a long term, we are now in a bearish environment. This is a bear market rally, a dead cat bounce, similar to what we saw over here. And usually it leads to a much larger sell-off. And I believe we're going to see a much bigger sell-off than we saw in 2022. So that is kind of that view. And if I was to just, if you're just look at the price action of this chart and I flip over to the NASDAQ, you can see it's pretty much the same chart. And if I
Pretty
flip
much
to
the
the
same.
Dow, again, it's very similar, the same chart. They all move together. It's just which ones move more or less percentage-wise in most cases.
Yeah. Now, if you go back to the S&P there on the if you can clear your drawings, yeah. And if we do a Fibonacci extension, so from like the bottom all the way, yeah, the recent bottom there up to up to there, good, and then back down, and then you get about 100% retracement right there, just right around the 200-day moving average.
Yeah.
And I thought that that might kind of capture the upside of this bear market rally. And then we came out with the news on China, coming to a deal with the U.S. and it just blew through that. But can you still kind of use that as around the top? I mean, it's not exact, but
Yeah, typically once once you've hit that level, we need to recalibrate. And the one that we've been going off of is actually, let me just get rid of this line here. The one that we've been looking at and focusing on since we've already kind of blew through that was this rally up and the market consolidated here. It actually had a high here. It
hmm.
sold down this day. And so I'll just carry that forward.
Okay.
And so we're actually just getting to this next level. So this rally is based on this move up and then it came back down on this day and then it recovered and now it's hit the 618, it pulled back and we're about to hit this 100% measured move. We actually just locked in half of our position. We did get long the markets for this bounce, the S&P 500 and the NASDAQ, and we've hit both targets, the first two targets on those. And now we're waiting for the next one, but we're about to hit another resistance area. And of course, this measured move, if we just draw it across the chart, is a pretty significant pivot area on the chart. You can see this little side day here and all these lows.
Yeah.
If I actually just flip over to our trading signal, you can see this were those three side days. Our strategy said get out of the market. The market had a bit of a hiccup trying to figure out what to do, and then it broke down. And so the market is, starting to shift to a short-term uptrend. I don't think it has a lot of upside potential, but it definitely has got a momentum shift here. And it might still want to push up and come and tag the highs or push a little higher, but we are long the markets, a few different markets and sectors at this point, kind of taking advantage of this bounce.
Okay. Interesting. Interesting. Okay. Andrew has a question here. I think you kind of hit it. He says, given the recent rally in the S&P on the back of U.S.-China tariff pause, what are Chris's thoughts on a potential short squeeze fueling a further S&P Nasdaq rally in the short term. So you could see a tiny little bit more, but most of it's kind of baked in the cake, you think?
Yeah, the short squeeze I touched on is a break of really this high. And
Okay.
I believe this is the short squeeze that's happening. People are now covering, plus it was good news. And the gap was so big. For some reason, everybody just throws all logic out the window just because there's a huge move on news. They all suddenly, totally change their mind in the direction. So this is really good. This is what I mean, it's bad for the general public, but we want the shorts to cover. We want everyone to get bullish and start screaming like, they are moving into the ARK ETFs. They're moving into the fast small caps and micro caps at this point. So people are loading up on the aggressive stuff. And that's telling us they're confident. They believe we're in a bull market. And in most cases, when the masses do that, they end up buying up here. And then, of course, it'll crash down here. And as it breaks this low, eventually they'll sell it out and they'll be like, wow, that was brutal. I just did that over here where I bought and then I panicked out and then I bought and I panicked out. I see this all the time. I mean, it's painful what the average investor goes through, the self-guided investor who really doesn't have a thought out strategy. They don't understand how the markets work. And they're really just running on pure emotion. It's a real gamble and a real struggle.
That was me before I learned to read a chart.
Yeah, this was all of us.
Right. Okay, let's move on to the dollar. What do you see in the DXY?
Yeah, when we look at the dollar index here, we've got it's carving out a bottom. I like the dollar. Well, I think the dollar and the Canadian currency. I think you and I'll touch on that in a little bit, but I do believe the dollar is going to do well. It's kind of one of the most hated assets right now.
Mhm.
It's the tariffs came in and really did a number on the price of the dollar. It went to be one of the most hated. It broke a very significant low here. It broke another significant low here, which creates this huge wave of panic. And if I mention or say anything bullish about the dollar, everybody jumps down my throat. And that is a good sign. That usually is a contrarian play. And it's the exact opposite for gold. Gold is screaming up and is trading at new all-time highs. And I say, listen, I think gold is topping and I think the dollar is bottoming. And I get my head blown off by both parties. And when people are that sensitive and that strong of an opinion, usually it means, okay, gold's probably going to be pulling back. The dollar is going to find a bid and start to move higher. The short-term charts show a inverse head and shoulders on the dollar here, a very small one, um, there's this little one that I talked about several weeks ago. We had this little neckline here, and we went from a precipitous fall to a rally, a pause, a rally, a pause, a rally, and it's pushing up. And now it's kind of at this first key resistance, the 50-day moving average, a very significant high volatility level on the chart that if you carry this across, you can see it's also a very significant pivot back from previous September. So I'm overall I'm bullish on the dollar. I think it's going to be working its way higher. And we tend to see this during a financial reset, which I believe we're going into a global one, which you can't really stop once I think that it goes through a cycle that's unstoppable, a lot like the ocean tide. Usually the dollar index does well. It usually shoots higher and becomes one of the top performers while everything else kind of gets beat up. And it will, if the dollar does scream higher over time, it will put pressure on commodities for sure, and cause a lot of pain, I think, in the commodity market temporarily.
Okay, I'd see the same kind of thing, resistance around 101, 102, somewhere in that zone. Let's say it broke, let's say it hit the 50 moving average there and then shot down and
Mhm.
broke that previous low of whatever it was, 98, 97.
Yep.
Where do you see like the next place where it would get caught? Like, because I was looking at that the other day. I had a subscriber ask me about that, and I'm like, does it look to me like let's say it did fall out, and
Yep.
and you and I were both wrong, and the dollar does not get stronger. Where do you see the next catch point?
Yeah, the big question would be like where does this drop start? Does it start from here or did it start from here? I would naturally kind of feel like it would go from here. So I would
Yeah.
say from there, this drop, and this is the retracement back up. So if we were to look, you can see it's going to be a pretty precipitous fall, percentage wise, from where we are as of you and I are speaking right now, at pretty much 100. That's about a 5-6% drop, around 95.
Yeah.
That
Okay.
would be that next kind of move to the downside, which is fairly significant. We could take a more conservative approach as well and go from this high, saying this is where that drop started, and this is where it recoiled back up, and it obviously moves it up, but um, there's definitely a lot of downside. 4.5, 5.5%. Either way, it's a pretty big drop, and it'll shake things up, no doubt.
Okay. All right. That's what I saw. I saw 95, and then the next one after that looked like
Mhm.
89 or 90 or something. It was way down there.
Oh yeah,
Okay.
that's far.
All right. Now, I've also got a lot of Canadians in the audience, and they're very curious about the US dollar versus the Canadian dollar. What do you
Yeah.
see in that?
Yeah, so I don't have a good chart for this other than we'll just pull up FinViz. I like to look at them when I'm looking at currencies because I hold my trading account in US dollars, even though I am Canadian,
Hmm.
because it's been in a strong uptrend or holding its value for a long time. There's a good currency exchange. More or less, we've seen the Canadian dollar or get up to this level several times. Each time it's pulled back. I do feel like if the economy kind of goes off a cliff, I do think we're going to see more or less the U.S. dollar scream higher, which would send this up. Now, based on Fibonacci, which I can't pull up on this particular chart, it's pointing to 160 or a dollar 60 all the way up to a dollar 73 exchange, meaning one US dollar is a dollar 73, which is huge. There is big potential. And of course, there's a lot of stuff that has to come into play for all that. But that's what this chart, Fibonacci, based on this low, this rally, and this pullback, it points to these levels way, way up here. And of course, that means the U.S. is trying to restabilize. It's strengthening itself in global trade with the tariffs, trying to level the playing field, or however that is going to play out or work. And maybe Canada falls apart. We've got somebody new in control, and I mean, they don't want to use any of our resources. Canada is rich. We're rich in lumber, in oil, natural gas. We're one of the top uranium producers. We've got so much stuff, and our leader doesn't want to touch it. Instead, they want to do most ridiculous stuff and just scam people and do all these crazy things and spend their money everywhere else but what we have. So Canada could fall apart, and the loonie could fall, which would help fuel this even higher. So that's kind of my take. I still hold the dollar with large investment capital. I believe it's going a whole lot higher, the exchange. So for Canadians, holding US dollar, I think, is still the best play. It's been beat up a little bit lately, but in the grand scheme of things, man, it's still a great exchange. And I think there's a lot of upside as we go through this turmoil in the financial system.
Okay, well, there is no business case for oil and natural gas, and the budget will balance itself, Chris. So there you
Yeah.
go. All right, let's take a look at gold. What do you see on our favorite yellow metal?
Yeah, I think gold's got a pretty interesting chart pattern. I think the most interesting view. Okay, we can look at it short term wise. So short term wise, we did actually have a little trade in gold recently. We got in on this pullback. We actually sold out right up here,
Nice.
closed out half of our position. Gold is short term wise is actually still pointing to a higher price, to about 3,750. Potentially could be the next push higher if it can get a bid. You don't want to bet against gold, but when you look at the big chart of gold, I think you're still paying kind of nosebleed pricing up here. I think it's pretty high and a little bit overpriced temporarily. And the reason I say that is because if we go back in time, and we could use Fibonacci on here. You and I have done this a few times. We have this rally up
Hmm.
from this was the major low in 2015 and down to here. If we come up to this level here, it gives us this 100% measured move, which we were expecting around 2,800. There was another one that you and I actually covered on here as well last time we talked, I think, which goes all the way back to the previous super cycle, up to the high and down to this low. And if we carry it forward, you can see it's at the same price. So we have like a 20-year super cycle measured move, plus the start of this new super cycle, which started in 2019, the low and the pullback. And what's interesting here, Steve, is each time we've hit these measured moves, and there's other ones on the chart. There was a measured move here. There was a measured move over here. There was another measured move right over here and another one over here. each time we hit these measured moves using Fibonacci, these little spikes and these squeezes to the upside, each time we had one of these, and we're at one right now, they
Yeah.
were all 22 to 24%, blowing past the target. Everyone piles in, or at least the price shoots higher. And then we go into a multi-year pause and a fairly, if it's not a pause, it's a steep correction in price. So that is where we are, I think, in the bigger picture. This year is about a 24% squeeze above our target, same as all these other ones. And the scenario that I believe we're in is the stock market is topping. And that's one of the reasons why gold really does take off is, right now, I think people who hold gold are very bullish. They know it's in a bull market and they're like, I'm not going to sell it unless you pay me a premium. And so not everyone's piling into gold. It's just the people who have it don't want to sell it.
Yeah.
And so it's very easy for the price to get bid up. It takes a few buyers only and it goes up in price because actually most people don't hold gold or they have a tiny fraction of a percent of their portfolio. I believe there'll be a time when they pile in, like I think in 2008, we had that market correction and almost nobody had gold. And then suddenly up here, this is about 3.5% or 1.5% of portfolios on average was in gold. And so I think we're going to go into a bigger correction in gold. It's going to become that sweet spot. And then, of course, we're going to see it rocket higher. To take things one step further, Steve, if we take a look and compare these two charts. Now, this one here on the left is 2007 and 2008. This was a 2008 market top
Okay.
or 2007 market top. And the stock market had this huge correction to the downside and it broke down while gold shot up and outperformed the market. Well, we're seeing that same thing right now. We just had a huge pullback in the US stock market just this year,
Mm-hmm.
and gold has shot up. And
Mm.
so this is when we have this huge, movement in gold and it becomes that safe haven play, it typically looks like it's going to be the start of a bear market. And if we were to just fast forward to the 2008, you can see here, this is where the stock market fell 57%. Gold pulled back 34%. And
Mm-hmm.
so I believe we're going to be doing something very, very similar to this, meaning we're going to see the stock market eventually roll over and sell off in a big way. Gold will get pulled down temporarily. And eventually, when gold finds a bottom and starts to reverse and move higher and starts to build a larger base before really taking off, gold will be our early barometer saying, okay, the stock market is, in the late stages. Precious metals will come to life, miners will come to life. But that's where I think we are. I think we are in this spot right here where gold is more or less peaked. The stock market is bouncing up, and I think the market's going to roll over, and it will pull gold down. And when we look at the S&P 500, actually, we'll look at the chart of gold on the daily chart, and when we zoom in, about a month ago, we had 3 or 4 days of real panic selling, bear market style panic selling in the stock market.
Mm-hmm.
And gold fell like 7%
Yep.
during those 3 days of real true panic selling, the type of selling and fear we see during a bear market. Bear markets last a long time. Gold is resilient right now. We're in that phase. But just think if we do enter a full on bear market and we go and the stock market starts to sell off for a long time, gold's going to keep getting hit with the stock market and sell off. And that's kind of where I think, we are headed. And you and I have shared this chart before, which is gold tends to do very well and outperform right at a market top, but then eventually it will kind of all sell off with it. So that's my take on gold. The really long term, looking forward like 3, 4, 5 years, super bullish on gold. But right now, I think it is flirting kind of with that top where it could reverse and break down in a very quick way. We could see it back down at 3,000, I think, in a heartbeat. So you got to be very leery and aware that yes, gold is in an uptrend, but at any point here, it's going to put in a very significant top and reverse down, and I think sell off with the overall market.
And that makes sense too, as leveraged as the markets are now. Gold is money, and it's like Rick Rule says, it's not necessarily sold because of fundamental reasons. It's sold by the margin clerk. He's got a cover, and gold always has a bid, so he can sell that, cover his positions, and not go out of business.
Yeah.
So downside targets on this, you could see it going to 3,000. Where are your main support levels?
Yeah, I mean, if we were to, let me just zoom out a little bit further here. I would think the most conservative level using a Fibonacci retrace will be somewhere around 28 to 2,600. But
Okay.
the reality is if we actually go to where this whoops, let me just get that. Where the last super cycle kind of started, the bottom in 2015, that brings us down to about 2275 to 2550 in that range.
Okay.
And what's interesting is, if we take a look percentage wise from the high, that is, that 34%. Gold pulled back 34% during the last financial reset in 2008. And so based on Fibonacci, that's actually what this chart pattern is pointing to as well. And it's not a bad thing, obviously. Long term, this is needed, and then it usually builds a base and it'll go much higher. But there's obviously a pretty big haircut here, potential. You're looking at potentially over $1,000 a share drop, which if you're a precious metals bug, you don't really want to hear it. But this is what the charts are showing and what is very possible if we do go into a financial reset.
I hope you're right. That would be an amazing pullback. I mean, we made a lot of money in the miners recently and trimmed and taken profits. I'd love to rinse and repeat and do that again.
Yeah. Reload at a better price. And
Yeah, exactly. Yeah, yeah. Just rinse it.
Years of upside potential.
Nothing's
That's the
worse
nice
than a
thing
chart
is,
that goes sideways, you know?
yeah, exactly. Yeah. When you buy after a financial reset, you can pretty much throw a dart at anything and you're going to be really good, over the next several years. And that's a financial reset hurts short term if you don't know what you're doing. And if you do know what you're doing, it's an opportunity, but it resets those charts, and having dry gunpowder to reinvest in your favorite stocks and commodities, is priceless. It's life changing when you can avoid a crash and redeploy all your money at a market low.
Oh man, yeah, yeah. Uranium is a good example of that recently.
Yeah.
Okay, so that answers Andrew's question on a pullback for gold. Let's look at the silver chart.
Yeah, so silver, I'm not a huge fan of silver. It's really noisy, it's choppy, it just doesn't fit kind of my risk profile. It's come right up to some very significant chop and highs in the charts. It really got hit hard with the selling in the stock market. It fell like over 20%, when we saw that crash in April. Just going to show, like, it takes a staircase up, elevator down. It is building a bull flag here. And if the precious metals space has one more push to the upside, silver could get a bid and it could rally to about $38 an ounce from here. That's what this chart pattern is more or less showing using a fib extension. So silver held up really well. The day that the tariff was announced on Monday, gold fell 3.5%, about $100 an ounce. Silver just held its ground.
Yeah,
And
it
that's
just went
simply
sideways.
because I
Yeah.
think a lot of people were piling in and chasing gold. They had FOMO because it's been hitting new highs for a long time. And usually whatever moves up the most when it does reverse is also what's going to pull back the most percentage wise. And gold has done that. And the volatility in gold right now is huge. A big day for gold used to be like 1% or 1.25%. Now it's moving like 4%, 3.5% almost daily from the highs to the lows. And that is a sign of instability. It's a sign of kind of, a bit of a bubble or overbought market condition. You got to be aware volatility is high. And, but yeah, silver is holding up in a bull flag pattern pointing to 38. But it has a lot of resistance. This line across the chart goes way back in time.
Yeah.
So I'd be aware even if it does get up to this 35 and 25 area, locking in gains, moving your stop up. And if it keeps on blasting past it, awesome, take advantage of it. But if it reverses and sells back down, at least you've locked in some gains and you can move out of the position with a small gain.
Okay. Yeah, that was going to be my next question. Is like a lot of us got into SILJ on that recent um, pullback, and I was kind of looking at the $35 level as a profit taking zone.
Right, right. Yeah. Yeah, it's had a really nice move.
Yeah.
SLJ is a fast mover.
Yeah, yeah, it is. Yes. Okay, so going back to silver there, what at 38, how did you get that? Was that just another extension?
Yeah, that was just a Fibonacci extension, which if I just grab this, it's always a question, do we grab the spike lows or not? I usually draw both.
Okay.
But if we take this level, you can see the rally up and this bull flag pullback shows 35 and then 38. Yeah, so that's where that is. I mean, you could definitely, I generally go for the more conservative play. I usually will try to avoid kind of a washout news driven spike.
Yeah.
And so it shows more 36.40 would be a little bit more of a conservative level to potentially take gains, pull more profit off. If it does blast past this 35, this would be your next level to trim a bit more or really start ratcheting up your stop to be like, when it does roll over, I want to make sure I get out. You have to trade, I think, silver here very aggressively in terms of defending your position and your profits.
Okay. Okay. Yeah. Yeah. All right. What do you see in copper?
Yeah, if we take a look at copper, I don't follow it too much. It does have a pretty big bull flag pattern. It looks like it wants to maybe take another push and rally to the upside. Um, I haven't been a big fan of copper for a while because I believe the economy is kind of slowing and copper generally doesn't do very well. But it does have a bull flag pattern very similar to silver. And it is pointing to higher pricing if it can get some traction. But yeah, I don't have a whole lot of insight on it other than if we were to draw where the momentum of this move would be, we could see copper go right back up to this high. It's
Yeah.
537. So if it starts to catch a bid and start to run up, $5 and then 537 are going to be those two targets. I think if we get good trade news, more good trade news, and I think copper could actually really pop because it's kind of a global economic indicator, and tariffs have put a kind of a halt to that. But I think if things start picking back up and orders start flowing again, it's very good for copper, and people might start to really accumulate it and drive the price up.
Okay. And Boy Wonder's asking a question. He says, if you overlay the copper futures chart and the U.S. Fed funds rate, do you see any correlation or any pattern there?
Yeah, I don't have that. I can't do that. I'm not sure. I can't help you on that one. Sorry.
Okay. All right. And uranium. Steve wants to know, what is your outlook for uranium?
So my barometer of uranium is URA. I think there's a Sprott one as well. I mean, we're long URA. We actually bought it a little while ago. We trimmed off some profits a couple days ago, and we're just letting it run now. So short term, I mean, it does have it's had a very nice move. It's moving up. It is definitely into a resistance zone. If we were to just kind of block in a large chunk of the volume through here of highs and lows, there's no doubt it's pushing up into a resistance area. It's
Yeah.
been a very, very strong rally. I feel like the stock market and everything is actually very close to resistance and about to run out of steam. So I do believe, these it will probably top out. I don't see it actually going back up to these highs and screaming higher. I think the damage has been done to a lot of things. I think there's a massive double or triple top in here. I think more or less this big move down to the downside has been a sentiment shift from more or less uranium stocks kind of had this bias where they kind of moved up and now they've kind of topped out. And now I believe on average, they're going to work their way down. So I do believe, if, if people hold uranium, I mean, I think, there's a lot more downside potential. I think selling at resistance after a strong move like this, especially if the stock market tops out, uranium stocks are going to get beat up and they're going
Yeah.
to collapse very substantially, along with everything else. So um, I know a lot of people love uranium, and there's an amazing story for the fundamentals of uranium. Same with gold and a lot of those other commodities and plays. But the reality is, when we go into a global reset, everything sells off pretty much, other than like the dollar, and maybe bonds will act a bit of a defensive play. But you just have to be aware that this, I think, is a bounce. This is a bounce into resistance, and then it's going to be making some lower lows, and it'll be a good opportunity to the downside, a good opportunity also down the road to pick them up at really fair value, I think.
Yeah. Can you pull up the chart of URNM? That's the Sprott one you were talking about.
Yeah, so it's this is very, very bearish. I mean, it has clearly broken down, put in a little double bottom, came up for a dead cat bounce, up into resistance. It sold off, and now it's bouncing back up into this resistance. So very similar levels, right? We have
Yeah.
this is kind of a resistance area. It was support, became resistance. Now we're kind of right back into this one. And that's the definition, kind of a typical market, right? You have higher highs, and then you have kind of double top, and you've got lower lows. And it's the same with higher lows and then lower lows. Eventually you have this kind of topping phase, puts in that double top and a breakdown. And yeah, I'm not a bullish on this sector. In fact, I'm really, really excited about uranium stocks. I'm more excited about uranium stocks than I am of precious metal miners. But we have to wait for the time. I'm hoping like late this year or early next year, the markets reset and cleanse, and we'll have an opportunity. Just because I have a bearish outlook doesn't mean I don't like them. I do love them. I just don't fall in love with things that I have to buy them. When it doesn't make sense. I'll wait to buy them, to me, when it makes sense from a technical investor standpoint.
Okay, yeah. Now on this one, and then URNJ, so it's even more leveraged. What we did was if you look at that little double bottom there on the kind of top, no, to the right. Yeah, right there. So we got there, and then we got the recent bottom. So we're way in the black right now. And I was
Nice.
looking at taking profits kind of around the upper edge of that 200 moving average.
Yep.
Yeah, the green one. But you're kind of thinking we might even peter out a little before then, huh?
Uh, yeah, I mean, we locked in some gains a session ago. So it is in a very strong uptrend. This 5-day moving average, as long as it holds above there, I mean, it's in a high momentum move. This could very easily pop and blow off, meaning it has a very strong move and shoot up. So
Okay.
I would just make sure it doesn't hurt to trim gains,
Yeah.
simply because the stock market is getting close to resistance. I typically always gauge everything around the stock market. If I know what the S&P 500 is doing and where it's going to run out of steam, even if an individual sector or stock hasn't quite hit my target and is getting close, if the stock market shows it's hitting a resistance level, then sometimes I'll sell my stock position, because if the stock market pulls back, the stock is going to pull back, or the sector.
This is
So
going to pull back too.
I do think it has a little bit of room, but there's no doubt you're coming right up into resistance right up here. There's
Yeah.
another little few percentage points, but
Okay. I might be picking up nickels in front of a steamroller, is what you're saying.
yeah, could be.
Okay. All right. That answers Steve's question. All right. Let's go on to MS here. He's curious about oil. Could you pull up WTI?
Sure, yeah. So oil's had that big breakdown, and below that $65. And I think you and I actually talked about this a month or three ago,
Hmm.
saying like, if oil breaks down below this level,
Yes.
that's going to be a very bearish sign for the economy. And of course, it has broken down, and now we're starting to see, GDP numbers aren't looking the greatest. Businesses are slowing because of tariffs, and everybody's hit the brakes, the pause on construction building, on importing, on all kinds of stuff. And of course, oil kind of saw all that, I think, happening before it really kind of kicked into place. And to me, oil's in a downtrend. It's got a little bit of a double bottom. It might push up and want to get back to 66, or push even higher, somewhere up into maybe 68. But I do believe it's a kind of a bearish bounce, right? I think we're going down to about $45 per barrel eventually, which will hurt the energy stocks, and it'll also mean the economy is slowing and there's going to be less demand. There isn't a very bullish story for oil, in my opinion. Just the chart looks terrible. It is in a strong downtrend. And I think the economy's slowing, so there's going to be less demand in general. Plus, I think they're talking about producing more oil. None of that stuff really bodes well for um, oil prices.
Yeah, that was my exciting part here. Was you and I both agreed that when you get price action just along that 65 or $67 level or what it was for so
Mhm.
long, it just makes it weaker and weaker every time. And so far we've been right, and that's played out.
Yeah.
And now I'm kind of looking for like my thought for this week or the next was if it gets back up to that like 65, $66 level is possibly running a short on it to the downside. I don't know what the duration would be, maybe 3 weeks or a few months. But what are your thoughts on that?
Yeah, so I like that idea. And we instead of doing oil, I was looking at XLE as that play. So
Oh, okay.
we've been looking at XLE to take advantage of it for a bunch of reasons. But overall, what I've been looking for, we saw XLE break this massive support level.
Hmm.
It completely flushed out, and I was telling everybody we really want to see it break and pop and squeeze up somewhere into this area here.
Uh,
And the stock market will most likely bounce at the same time because they kind of all stocks generally move together.
yeah.
And so what we want are the shorts to cover, which I think anybody who's short is covering now on this rally. I think we're going to see this come up into resistance. And then as the stock market rolls over and gives us a sell signal on the stock market, wherever XLE is, hopefully we want to see it rolling over. We'll enter an inverse trade. So as XLE drops, the inverse trade will go up. I think ERY is like a 2x or 3x inverse ETF on this space. To me, it's actually a cleaner setup with a lot more profit potential than oil itself, but they're both pretty much the same trade. But I do believe XLE has the better chart pattern to do it. And so far it's moving exactly as we want. People are starting to get bullish on it. It's popping up into resistance. And when the stock market rolls over, this will be something we'll be looking at as buy an inverse ETF. I mean, there's going to be like 30, 40, 50% potential to the downside with the leveraged ETF. And as you can see, it can drop very quickly. We could see within a couple of weeks, you could have a 30, 40, 50% move in these type of trades. So I like your idea, Steve, on
Okay, okay,
shorting
yeah, we
oil.
might get a little island reversal there or something on the 200,
Yeah,
right?
yeah.
Okay, all right, cool. And you would play that not with a put, you'd play that with ERY, that's an inverse?
Yeah, ERY, it's a 2x inverse ETF, and you don't chart with a leveraged ETF ever. Tip to traders, don't chart with it. Use the underlying actual commodity or the index. The SPY and QQQ you can use. There's enough liquidity and there's no leverage. But when you get to a leveraged ETF, don't think like, oh, it's right in the middle of support here and to buy it because they do lose value. You wait for XLE to give the trade setup, and wherever this is, which could be right back way down here, that's when you'd get in. You use the XLE as your trade signal, but then you actually use the ERY as your trade vehicle and chart and use your targets on XLE to tell you when to just get in and get out of ERY, if that makes sense.
Okay, yeah, that goes in line with Tika's question. He says, "Hey Chris, I'm wondering if you knew why inverse leverage ETFs don't always correlate in percentages." He gives an example of XOSS and XOXL. Do you know what I forget what they call it. Is it like
Yeah.
degrading or
Yeah, well, for commodities, it's like called contango. I think there's all
contango?
kinds of different stuff. But in the long story short, is leverage ETFs have complicated formulas. They have to constantly rebalance. They have to buy futures or options or whatever it is to try to get that leverage, that high beta out of it. And by doing transactions and running all this stuff and how everything moves, it loses value over time. There's a high cost to leverage ETFs. They're not very efficient. So again, the key is chart with the whatever it is you want to trade, the asset or the sector or whatever it is, but then use the leverage ETF just when you have a signal. Don't chart with the leverage, and because it'll lose value over time. 2X's are not the greatest. 3X ETFs are terrible. So be very cautious with a 3X. They can lose a lot of value and cut pretty deep on top of that.
Yeah, short duration only because they rebalance at the end of the day, and you'll lose your shorts if you
Yeah.
hang on to them for a long time. Okay, XLE we just hit. How about XOP?
Yeah, so XOP, the gas and oil exploration, these are, kind of like the little gold miner companies of the energy space, very volatile. Again, series of lower highs, lower lows. It's recoiling back up into a resistance area. Again, um, bearish, it's getting into resistance. You just have to let it top out, let it start to roll over and head down, and then bet on falling pricing or an inverse ETF. If you know if you own energy stocks, we're getting into a nice territory to trim your losses or to get out for a gain depending where you got in. It's definitely getting into resistance.
Okay. He's also asking about Chevron, and then I threw in Exxon too.
Okay. Chevron, I mean, each individual company will have some of their own skew and what's going on with them. Obviously, it looks like it's put in a little bit of a double kind of bottom here. It's trying to pop and move higher. Let's just look at the big picture, though. Get a feel for it. So this, if Chevron breaks down, I think it's going to have a if we do see the stock market go off a cliff here in the next month or two,
Mhm.
this one looks like it's going to get hit really hard because what's happened right now with Chevron is the stock market has put in this massive, massive bounce, and so have all the other energy stocks. Well, Chevron has barely budged.
Yeah.
If we, it's kind of like the dog of the sector. Something that doesn't bounce and rally with the stock market after a huge drop, that one, as soon as selling pressure hits the market again, it is going to collapse. So using Fibonacci to this drop and so far this reaction high, it is showing that Chevron is going to go for one huge move to the downside if it rolls over from where it is right now. You're looking at like a 25% haircut in price, so it's not the best looking chart, that's for sure. I'm not a fan of it to the upside. I'd be more inclined to just let the stock market see if it rolls over, and then play the downside of the energy space.
Okay. Do you see a bear flag there?
Yeah, that's more or less what it is. You've got the drop, you've got this
Bull.
bear flag, it's flagging out, trying to figure out what it's going to do, and it might want to continue to go higher and take some time. But a bear flag, same thing. You use Fibonacci or draw your bear flag pattern, it'll come to
Yeah,
the
same thing. You
same
drag the pole
targets.
down. Yeah. Okay. All right. And what do you see with Exxon?
Let's take a look. Again, another pretty messy, ugly chart. I'm not a fan of the energy space until it kind of tops out. It's moving with the stock market somewhat, but again, getting up into a resistance zone. It's got these highs across here. Yeah, just overall, you can look at this. You could be like, okay, this is a drop, and then this is kind of a bear flag. Moving up into resistance, and the next leg will be to the downside. I think Chevron out of all of them probably is the most bearish looking so far. Like that would be the one I think could drop really nicely. The only catch is there isn't a leveraged ETF for Chevron, so the XLE leveraged ETF will probably give you more opportunity than trading an individual stock if you're playing the downside.
Okay. All righty. Awesome. And let's move on to Bitcoin.
Yeah, so Bitcoin, where is
We had
this?
a nice move recently that shot up.
Yeah, Bitcoin's been great. We're long Bitcoin. We trimmed off some profits a couple of days ago. It rallied, it paused, it rallied, it paused, it's rallied. It's right now pausing above the 5-day moving average. It is stuck right here at some pretty major resistance,
Yeah.
and we've locked in gains. And now you just have to let it do its thing. Like it is in an uptrend. All the moving averages are layered really nicely. We got the 150 day, the 50, the 20 and the 5. They're layered nicely. Price is in a high momentum move. Now we just kind of ride it out. The next pop here, we could see Bitcoin go to about 135, $134,000 per Bitcoin if this breakout actually takes off. And that's based on a monthly chart, actually, analysis. The monthly chart of Bitcoin is a very nice looking chart pattern. You and I have kind of touched on the long-term pattern before. We've had this big bull flag pattern. We had played it over here and we got out at 108 up here. And now it's flagging out again with another pattern. It's not quite as sexy as this flag was, but it is holding up right up into resistance right here. Very similar to what we had last time. And it is pointing based on the monthly chart to 134, 135,000. So Bitcoin could have a big push. You get a lot of attention. Gold might have a push higher as well for that final push if they're going to move together. But anyway, Bitcoin, I like Bitcoin. We're long Bitcoin. And we just have to now let it do its thing. We're in it. It's like a free trade with some profit. If it takes off, it's you know cash in the bank. If it rolls over, well, we made a little bit and got out unscathed with a small gain.
Okay, and how do you how'd you get to the 130, 134, 135 level?
Yeah, so if we take a look at the monthly chart, I use the Fibonacci extension. So I'll just
Okay. From the
grab
bottom
that
of the
tool.
cup to the top of the cup, maybe?
Yeah,
Oh,
go
from
from the
right there, the hand.
low to the high of the bull flag to the bottom of the bull flag. And then let's drag this down a bit. You can see 135 is that next upside 100% measured move.
Okay. Okay. Awesome. Well, thank you, Chris. Let's see. Going on to some listener questions. We can stop sharing screen here. And then let's see. Team Player is curious. He says, how do I know when to sell my shares in a stock that got bought out? Is the buyout share price locked in so we get to sell any time that are at that price without worry of it dropping? What are your thoughts on that?
Yeah, I don't know the fine details. I've had that situation before. If a company's going to gets bought out, sometimes the price just jumps to that buyout price and it stays there for a long time, and eventually you're just like, this is boring. I guess I'll just sell it, which is what I did. So I don't know the full story. Maybe different types of buyouts have different ways that the share prices move. You'd have to look into how they were bought out and chat GPT, like what to do, but. Generally, once a buyout hits, if it's a huge move, I usually exit that trade because now the game's changed. It's usually a surprise, and so I'll cash out and I'll regroup. And if I like it later, when I'm like, okay, now I get what's going on, then I'll re-enter. But sometimes it's best just to, if you don't know what's going on, the best thing to do is to like just step aside, figure it out. You can always buy a stock back. That's the way I see it.
Okay. And Scott wants to know, he's asking about the market crash strategy, and he says, if we pull all our money out of the market due to the economic crisis that you and many others are predicting, where would you suggest we put it? In CDs, physical gold and silver, money market accounts, until we reach the bottom and it once again becomes safe to invest. What's your advice there?
Yeah, I mean, it's pretty much one of the most boring positions, which is like a cash position. Just collect your 4.5% interest while everything falls apart. I mean, we will be trading inverse ETFs once we go off this cliff and the predominant trend is clearly down. We'll be trading inverse ETFs. So when the stock market falls, obviously we can benefit from it. That's the only other really way to do it. I wouldn't touch bonds yet. I think inflation's here to stay for a while. Rates could go up. I think there's a lot of risks still in the bond market, and gold and pretty much everything else will most likely get sold off. So if you don't know how to read the charts and you don't have a strategy to profit from falling pricing, then the best thing to do is just stand aside, follow the market, stay caught up what's going on, learn, and then eventually, when the market does bottom, you're going to have all that gunpowder that you can just throw darts at everything you like, and you're gonna win with pretty much all of them. You just have to keep your money until we get to that point, not throw it in too early, which most people do. People already thought they were buying the bottom back in February, March, and then the bottom fell out, and now people right now think we're starting a new rally. It's easy to get sucked into emotions. So cash is like the most boring, but one of the most powerful positions during a financial reset.
Yeah, I played that game during the COVID crash. I just
Yeah.
went to cash and then basically sat aside. And when we stopped getting stories of the stock market closing 2 hours into it opening, and
Yeah.
everyone was saying that stocks would never go up again, that's when I
Yeah.
piled in.
Exactly. Yeah.
It worked. I mean, later on, like when you look at the chart, it looked like I was psychic, but it
Yeah.
was
Yeah.
it was a it was a scary play at the time. But having
No
that
kidding.
cash, I was so glad that I had it when it bottomed.
Yeah. Yeah.
Jonathan is asking about managed retirement accounts. He says, for those who have 529 or 401k accounts that aren't self-managed and offer a handful of funds to choose from in which to invest, what types of funds would you recommend looking for, assuming the future outlook of troubled markets are likely and recession is likely?
Yeah, I mean, generally with those type of funds, you're a lot of times, depending on who you're with, you're stuck with mutual funds. So you can't really move them very fast or easily. Really, again, cash, I think until the markets prove that we're in a new bull market, or until they have, proven they've bottomed, like it crashes and we get a bottom, just collecting interest and preserving your capital, I think is probably the best thing. People who are always trying to make money and say, how can I make the most money? And right now, we're not in a phase where it's like that. It's more so protect your capital, be happy that you have it and that you can move it to cash. And And if the markets start a new bull market, say in a month or so, then you can always put it back in and ride it higher. But if it does correct, you're going to feel like a hero and you're going to be able to reinvest it later. So when it does come to time to reinvest, I think it'll probably be, a split. You have some precious metals, but the index ETFs are great. And also dividend ETFs. When the market corrects, you can buy dividend focused ETFs where the stocks have been beat up. The dividends are huge. After 2008 crash, I bought a dividend ETF on the Toronto Stock Exchange. It was paying 16% dividend,
Wow.
which is unbelievable because the stocks are beat up and they haven't dropped. Not all of them had dropped their dividends, and the ETF itself doubled in value over the next year. So if you can just keep your gunpowder dry and be like, you know what, I'm happy with 4.5%. I don't care about trying to squeeze, a little bit out of this market if it's going higher. You can do very, very well. So cash, and then when the time comes, look for dividend and index funds, and just let it ride for the next bull market phase, really.
Okay, awesome. Well, Chris, thank you very much. We will put your links down in the pinned comment below and the notes down below. What can viewers expect when they sign up with you at the Technical Traders?
Yeah, when they sign up, pretty much every morning before the opening bell, I share a 8 to 10 minute video of what's going on in the markets, what happened yesterday and overnight trading, how it's going to affect our positions. So more or less, you learn technical analysis, plus you get to feel the pulse of the market, of the emotions swinging. And we have tools and indicators to show when people are freaking out and when they have FOMO. And what I do in the newsletter is I share my trades. I share my portfolio. So you copy the same ETF trades I do, the same portfolio allocation. And I just trade my account. I ride the coattails of the market, and subscribers can ride the coattails of what I do, following me trade by trade with all the targets and stops and everything. It's pretty straightforward.
Awesome, awesome. All your links will be down below. Chris, always a pleasure. Thank you very much for coming on the show.
Thanks, Steve. All right, take care.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.